everyone, this is Amit Pabari, founder and managing director of CR Forex. After 112 days, Rupee has closed for the first time below 83. Now the question is whether it is going back towards 83.40 or it is moving towards 82.5. In today's presentation, let us understand that in the first part. Second part, what should be ideal hedging strategy for exporters and importers. Before deciding the view, let us understand what are the factors which are going to affect dollar rupee pair. On the positive side, flows. From last 2 months, we are seeing continuous flows in Indian equity and debt market. We expect the flows to come in on a continuous basis. Second, dollar index and 10-year US yield. They are in a downward trajectory and any upticks on dollar index has to be sold off, which is positive for all emerging market currencies and rupee. Third, our fundamentals are strong. So basically, at any point of time, when the fundamentals are strong, that currency generally appreciates. And lastly, rupee is undervalued as compared to other emerging market currencies. And if we compare with dollar index momentum, dollar index was 107. At that point of time, rupee was near 83.20. And today, when dollar index is trading near 102, rupee is still trading near 83 only. On the negative side, any geopolitical escalation between Israel and Hamas or any Red Sea related issues comes in, that can increase the crude oil price and our trade deficit and current account deficit can increase. Apart from that, if RBI comes and intervene near 80 to 90 kind of level, which they have been doing from last couple of months, if that happened, it can give some amount of pullback to rupee. Technically speaking, positives are more than negatives. Now let us discuss the outlook for rupee. On Monday morning, there can be two scenarios. Scenario number one, rupee takes a support of 80 to 90 because of natural demand by importers or RBI comes and intervene. If that happens, then the pair can bounce back towards 83.15 to 83.20 kind of level. But that uptick should be used by an exporter to increase their hedge ratio, because the overall theme remains the same, that the currency is going to move towards 82.5 and 82.20. The second scenario can be that it breaks 80 to 90 if RBI does not come and support rupee. If that happens, then there are higher probability that we will see a sharp appreciation in the rupee by at least 50 to 75 paisa, as exporters and traders will go on and cover their exposure. Monday mantra will be how well we plan our hedge rather than how well we predict the market. So let us discuss what should be the ideal strategy for exporters and importers. Now let us discuss strategy for thin margin exporters like agri exporter, chemical exporters. A lot of thin margin exporters are taking costing near 83 and above. For the last few weeks, we have been suggesting them that they should cover 100% on a back-to-back basis, as we were expecting rupee to appreciate, and exactly same has happened. On Monday morning, if the pair breaks a key support level of 80 to 90, then ideally they should not wait and simply go and cover whatever open exposure is there, because if 80 to 90 is broken, then we expect rupee to appreciate by at least 50 paisa on a rapid fire round. Let us discuss an important concept called Ostrich Effect. Ostrich have a habit that whenever they face an uncomfortable situation, they tend to avoid that situation. They will not face it. I will request all thin margin exporters that if 80 to 90 is broken, they should not do an Ostrich Effect kind of a scenario. They should simply go and cover. Now let us discuss strategy for thick margin exporters. If 82.90 is broken on Monday morning, then do not utilize the existing forward. Instead, plan to hedge more. And if the pair takes supports of 80 to 90 and bounce back towards 83.15 to 83.20 kind of a level, in that scenario, they should try to increase the hedge ratio. Now, let us understand what kind of hedge ratio they should have. On a confirm order basis, they should keep hedge ratio between 80 to 85%. On an anticipation basis, they should keep a hedge ratio close to 60 to 65%. Now, let us discuss strategy for importers. In a test match cricket, in the first hour of playing, general tendency of batsmen is that they will not play aggressively, they will follow a wait and watch policy. Similarly, on Monday morning, importers should also follow wait and watch policy. If 82.90 is broken, then they should wait to cover their imports near 82.60. How much they have to cover? They have to only cover 50% of the import payment which is due for next 30 days. If the pair takes support near 82.90 and bounce back, then they should cover only 30% of the imports which are due for next 30 days. Basically, the theme is play it like a test match, cover slowly. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे next week. Thank you.